Hello, and welcome to What is a Borrowing Capacity? I'm Russell Guard from Forward Prosperity, Finance and Mortgage Brokerage. Today we're answering one of the most important questions when you're thinking of buying a home, purchasing an investment property, or starting your very own business. That question is, how much money can I actually borrow? The amount of money you can borrow is known as your borrowing capacity. In this quick insights presentation, we will take you through what a borrowing capacity is, how a borrowing capacity works, and the important concepts that go into calculating how much money you can borrow. A borrowing capacity is the maximum amount of money a lender is willing to lend you. A borrowing capacity isn't a wish list or your desired amount. It's the lender's realistic assessment of what you can afford to repay given your current financial position, as well as rules and regulations. In simple terms, a borrowing capacity is your personal or business borrowing power, and it determines how much money a lender would be willing to let you borrow. Three key factors decide your borrowing capacity. Firstly, lenders consider your assessable income, which is income that is either completely or partially in your name. These types of income can be your salary, rental income, stock dividends, or even business profits. Secondly, the lender will assess your expenses and existing commitments. Lenders will look at every single dollar you spend to assess how much disposable income you have to pay off any new additional loans. Thirdly, lenders will also consider the interest rate and loan term. Higher interest rates or shorter loan terms can reduce the amount of money you can borrow because both higher interest rates and shorter loan terms generally make debt repayments much higher. How lenders calculate your borrowing capacity. To assess your borrowing capacity, lenders will run a serviceability assessment. This assessment considers your ability to repay additional debts after paying for all of your regular bills, commitments, and expenses. Lenders will also use something very important known as an assessment interest rate. This assessment interest rate is an interest rate buffer of 3%, which is imposed on your financial profile when the lender makes their assessment, but only to ensure you can still pay off your new loan under higher, more difficult interest rate conditions. This is actually one of the reasons that a small change in interest rates from the Reserve Bank of Australia, or even a change in your credit score, can make your borrowing capacity swing up or down by tens of thousands of dollars. Here's a realistic example. A married husband and wife on a combined income of $150,000 with low debts and good credit scores might have a borrowing capacity of $700,000 to $800,000 in today's current financial climate. For you to know exactly what your borrowing capacity is, we would need to run an assessment of your current financial position, and that's thankfully something we do very well at Forward Prosperity using our finance and mortgage brokerage services. Thank you for watching What is a Borrowing Capacity? If you're ready to know your real borrowing power, book in your free finance assessment today by visiting www.forwardprosperity.com. Thank you for watching this finance insight, and if this has helped you, please drop a like, comment your biggest question below, and subscribe to the Forward Prosperity YouTube channel for more economics and financial insights.